the P&L screen.
Sorry, go ahead. I got a few
I
more.
have,
training in
I
here.
have a hard time understanding the monitor screen on Thinkorswim. And for example, when I sell a put, my max profit is the premium. But then when I go to monitor the position, it shows that I have a profit or a loss. So how do I understand that a little bit better?
All right, let me share my screen for that one. Let's see.
It's a really good question. It confuses a lot of people, including me. So I'll be curious to hear some more of this.
All right, do you see my Thinkorswim screen? If you guys nod your head or say yes.
Yeah, I can see.
Yeah,
Okay,
yes.
so let's look at I actually don't have any cash group puts directly on this one, but let's look at a spread, for instance. So SOXL, try to say that 5 times fast. This was an iron condor I did where the current price is 65.12. I sold a 40 put, bought a 45 put. Did I do that wrong? No, I did it right. I'm sorry. This says -1. So I sold the 45 put, bought the 40 put. You always want to sell the put closer to the strike price, and then you'd get a net credit on this. Same thing for the call side. I sold the 90, bought the 95. Now, what you could do to figure out how much initial premium you got, if you didn't write that down, you could actually subtract these two numbers and then also subtract these two numbers on the call side, and that'll tell you the premium you received. I always write down my premiums, however, so wrong place. So whenever I'm doing a spread or poor man covered call, I'm going to write down the premium received. This is good for my information. And that was a separate question on like how to actually track this stuff. You don't have to go nearly as detailed as me, but once you know how much premium you receive there, then you could, the simple way to figure out what the current option spread would be worth, press click and then control click all of the options. You can also press the shift click and go to the bottom one of this particular position. And then right click, oops, sorry. Then you want to right click, create closing order. What is it doing? Ah,
I don't think you have to do it with the whole spread, right? I think the question was just on like a single like cash secured put or something.
okay, yeah. For this spread, this will show the limit price for the whole spread. If you do that for the cash secured put, you would just click on the actual one put that you have here, right click it, and then create closing order. You're going to see that. It's actually even simpler than that when you have a cash secured put. You can just look at the middle column, which is the mark price. That's usually the mid price of the bid and the ask. So whatever this mark price is will be what you could buy to close it at, most likely, not definitely, because it depends on the bid ask spread, depends on if you get filled or not. So an easy way to look at it is look at the price you sold it at in the first column. This is the trade price. And if you have the premium, this would be the premium you receive for it if you sold the put. The next column would say the mark price. If those are smaller, so if this column's smaller, that means you're already at a profit. If this one's higher, that means you're theoretically at a loss right now, but we're not going to necessarily close out of it right away. We might roll it, get assigned, sell covered calls, things like that. So Keith, does that answer your question?
So on that one that you have highlighted right there, you received the 37 cents and it's worth 35 cents right now.
Yeah.
So you received the 37 cents already in your trading account.
Yes.
And then, but you're showing a loss of $2.70. Does that $2.70 come?
Well, I bought this particular call because it was part of the spread, but assume I sold it. We would have sold it to receive $37 in premium, but then we could theoretically buy it back for $35 right now. So that'd actually be a $2 gain, not a loss.
Okay.
So yeah, you compare the two numbers and subtract them. So again, it's trade price minus the mark. This is how most of the initial settings are, probably in your Thinkorswim.
And so the way that you would receive the full premium is if you let it expire worthless.
Yep. If you let it expire worthless, let's say in December 17th, again, assume I sold this. The current price is 65.12, pretty big cushion to the 40. So if you just let that go all the way until December 17th, If it's still above 40, then this position will be cleared out of your account. You still get your premium, but then you would also receive that money back into your brokerage account if it was just a cash secured put. So pretend we didn't do any of this. You just sold a 40 put. You would receive $4,000 back into your brokerage because then you don't have the option anymore.
Cool.
Thank you.
All right.
Yeah, that helps. Yeah. Thanks.
Any other general questions? Good. I don't have a set order or anything like that.
No.
Just feel free when you're ready.
Yeah. Be cool.
And Russell, you could ask too.
Yeah. What's going to happen with VXX tomorrow? That's my question. What's going to happen with VXX?
Flip a coin.
Yeah. See what it is.
You can look at the pre-market and see. It's hard to tell. It's
Yeah.
pretty much based on the VIX, and that was one of the questions I wanted to go over, is a pretty good indicator of how much premiums might be for certain positions when you start them. So
Yeah.
essentially, if you have a very high VIX, then there's a lot of volatility in the market. Essentially, the market's not really sure if it's going to go up or down a lot with this new variant of the coronavirus. Maybe it's going to be much more dangerous and the stock market could easily jump high or low. So because of that, premiums are going to be more valuable. And then you could actually earn more premiums for pretty similar strike prices than if the VIX was really low. Because if a VIX is really low, then it's a pretty good probability of where the stock would be. But when the
Right.
VIX is high, it's a much more variation on
Right.
highs or lows. And that's what makes premiums higher. So
Yep.
a way to think about that is, let's say the VIX was 0, and we know for absolute certainty that all stocks are priced exactly where they should be, and they shouldn't be a penny higher or lower. You wouldn't make anything selling puts, because obviously if a stock's exactly at 100 and you try to sell a put at 95, it ain't going to move if there's no VIX.
Right.
So you'll literally make nothing. If the VIX is really small,
So what you're saying is it's the perfect market for selling puts. Is that what
right now it's a very good market to sell puts. The VIX is, as of last I checked, 27.19, which is a bit on the higher end, and it's one of the highest ends of the year.
Come on, Peppa Pig. Peppa Pig, no working, Daddy.
Sorry. I love Peppa Pig too. Sorry, I had to mute you for now. Anyway, so the VIX is very high, meaning there's a wide range of where a stock could be. It's almost like a bell curve distribution. So let's say a stock's exactly at 100 and there's
Yeah.
a very wide VIX. That means the stock could easily go to 80 or easily go to 120. And
Right.
because of this very wide range, the premium is going to be worth more because there's a better probability that the stock will actually get to your strike price, right?
Makes sense. Yeah.
So in general, it's good when VIX is high for premium sellers, because in general, the VIX does tend to decrease, especially after big spikes. That's not
Yeah.
to say it's going to go down from 27 to 20 in the next day.
Right.
It could
Yeah.
even go to 30 for all we know in the next few days. But
Yeah.
in general, when you see big spikes, it does tend to go down within a few days after that.
So kind of like we're in a period where selling it, you sell them, well, you sell your stuff in the morning because you get that uncertainty, that volatility in the morning first thing. We're kind of like that, but on a macro scale at the moment as well then, right?
Right.
So we're kind of, hopefully that'll be good. I have a question.
Usually in the very beginning of the day, the VIX is a little bit higher, especially if there was news overnight, because that is it Omicron? I don't know how to say this variant or whatever, but the that came out over the weekend, so we were expecting the VIX to be pretty high on Monday, and it was. It jumped up a lot. So.
Yeah. It's getting kind of watered down now, though, from what I'm seeing in the media, at least, that it's like a weaker strain or something, or like I don't know what's going to happen, but I have a question for the other guys listening. Like, is there anything in the service that you need like help with? Like, is there anything we could do to make it better? Like, could we email the picks out to you? Like, is there too much information? Is there too many? Like, there's a lot of channels. What are you guys following? Is there anything, along those sort of lines that you've got feedback on for that kind of stuff?
I think it's good just the way it is. Sometimes I struggle with, and this is just my own weakness, is understanding some of the abbreviations.
Right.
You know, like, okay, what does that mean again? Oh yeah, cash secured put. Okay, I got it. You know,
Yeah.
We'll do a quick help thing on the ebook strategy guide of what each acronym means. There's really not many I use. CSP is cash secured put, IC is iron condor, PCS is put credit spread, CCS is call credit spread, and BDC is buy to close. That's really all the ones I use in the end. But yeah, we'll put it up.
And the question I keep getting is how do people pick the cash secured puts? So you're putting out 2 a day, like at the end of the day. People always ask me like what should I do? Should I take them all? Should I pick one? Like, and I've just been saying, look, there's so many and the win rate is so high that it's not like a lot of other alert services where if you miss like one trade, you know, suddenly the guy who's doing the trades are winning and everybody else is losing because he was in the
Yeah.
winning one. The win rate is so high, you can just pick and choose what you want. I look at them and I look at my own technicals on them and stuff, and you know, go through and go, okay, that's the one I'll do today, or maybe I'll give it a miss
Right.
today, more tomorrow.
Like
Yeah,
like the one I did today with the Iron Condor on IWM, I put it out like 56 days out. And I did it around what 10:30 in the morning or so. But I was going to keep that as a recommendation for tomorrow anyway. And then I just looked at what the option prices were, and the ETF barely moved much from the beginning of the day to now. So that was good for a recommendation, and anyone could easily do it tomorrow. It's not going to be much different in where these prices are. I think that's one of the benefits to selling these really far out in time, you know, at least 30 days, 45 days plus. It's not going to dramatically move in a 10 minutes, an hour, where if you're saying you're buying a call and you're hoping it shoots up in the next 20, 30 minutes, yeah, you could easily miss those. So,
yeah, definitely.
as for the number of positions to take, I did leave I'll go through the Iron Condor shortly. Yes, Jason. For number of positions, I think I left an article on position size and management. And I think it's actually, I did mention it a little bit on the main ebook strategy guide. The very top says how to earn 4% a month selling cash secured puts. So we typically want to look at least 10 positions ideally, because we want to not have all our chips in one basket. You know, when they say don't put everything into one stock, because if that stock tanks, you could get screwed from it. So I think 10 is a good number. You could go a little higher than that if you'd like, but it will be a little bit more time consuming on your end. It's fine. It's up to you if you want to do that. I haven't found any huge benefit going much more than 10. So if you want to go crazy and get 40 cash secured puts and only do one contract, like, more power to you, but I haven't really seen any benefit to that. So then if you're doing 10 positions, if you're starting completely from scratch and you have all cash in your account, it will take you a week to get 10 positions if you're doing every single one I do. Right now, obviously, depending on when you join, depending on which ones you take, these are all optional. Get it? Option, bad pun. Like, you don't have to take any of the trades I want, or you could do both in the day. You could do one in a day. But as some of them start to buy to close, you're going to have cash available again. And then you could consider, all right, one of them closed. Maybe I like this position for tomorrow over the other one, and then just take that. That's why I've tried to give extra positions, because again, 30 to 45 days out, you could be stuck with some positions for quite a while. It could be 2-3 weeks in some of them, or you might have to manage them by selling covered calls and whatnot. So
yeah,
at least 10 positions. The easy way to figure that out is take your account value, divide by 10, and that's the approximate amount of money you could use per position. So just to keep the numbers relatively straightforward, if you have $10,000 in your brokerage, divide by 10, you would have $1,000 per position. And then in that case, you could sell a cash secured put with a 10 strike price, and then you'd be good for that one position. If the strike price is at, say, 5, you could sell 2 contracts of it, because 5 times 2 is 10. Or you could also sell 2 5-width credit spreads. So if I'm selling a 40, buying a 35, you have enough to sell 2 of those. And then as you go through the positions, you should have, I would say, at least 10 at most times. Okay. Now, obviously, if quite a few buy to close early, you might be left with a good lump sum of money. It might take a couple days at that point, but
right.
further out. So
Yeah. Yeah, very cool.
So Jason asks, can you walk through an iron condor? Where could I find the breakdown? Okay. So,
Iron condors are my nemesis as well. Right?
yeah,
He spent about 20 minutes trying to get me to do one.
it was most of my planning period in the morning.
I know. It's
I was
always
like, I need to prep my chemistry. I'm kidding.
uh,
Can you guys see my screen?
Yep. Yep.
All
We can
right,
see.
so let's look at SPY. It's the S&P 500. It's a very common one I sell iron condors on because there's a lot of volume, a lot of open interest. So that means the bid-ask spreads are going to be pretty narrow, which is what we usually want. We don't want to have a bid of 10 cents and an ask of $2 because you don't know what price you're going to get on it. So you want pretty low bid-ask ranges. And again, a lot of volume. For an iron condor, we want to look at selling a put much lower than the current price. So right now the price of SPY is 455. By the way, pre-market's looking good, 459. So we're up 1% pre-market. So we might want to sell, call credit spreads possibly for the 0DTE tomorrow, but we'll have to look more into it. Anyway, we want to sell a put credit spread and a call credit spread together. So just cash secured puts is when you sell a put and do nothing else. For SPY, it's very expensive to do that because it's 455.56. Let's just look at about 30 days out, December 27th, 455. We want a good cushion between that price to where we wanted to sell a put for. If you look at the delta column for iron condors, I wouldn't do anything more than 0.1. And ideally you go around 0.05 to 0.08 because that means it's a very high likelihood of working. So let's say you just wanted to sell a cash secured put at the 400 strike price, which is a good cushion from 455. SPY would have to go down over 10% in less than a month, which is pretty unlikely. Right now it says 8% chance. If you wanted to sell this put without making it a spread, you would need $40,000, which is a pretty penny.
Yeah.
Right?
Yeah.
So what we could do instead to lower the amount of buying power, we're going to buy a put with that. And the width of the spreads is how much it's going to cost in your brokerage. So let's go back to the option chain here. If we want to sell the 400 put, maybe we're going to buy the 395 put. The way to do this on TOS, I already left clicked the bid price, the 400. You see it came up on my end. You could press Control, click on the ask button, and then it'll automatically make it into a credit spread. Okay. See how it says I'm going to buy the 395 put. What's good about doing this is it's only going to cost the difference of these spreads, which is $500 to make this particular option trade. Okay.
Right.
The credit is $21 for about a month. If you take the $21 you're receiving, divide it by $500, I guess divide by 5 times 100, you get a 4.2% return. And all you have to make sure is SPY doesn't go below the 400. Okay.
Cool.
So that's a put credit spread. That's one side of the iron condor. Now, iron condor has two big wings, right? So that's one wing. We want to go to the call side too. Again, 455 is the current price. We want a big cushion. Those iron condor wings are really, really long, and they don't want to have to flap much. They kind of glide in the air and let theta decay it down, right? So we're going to go really far away from 455. We could even go near 500 even. Let's try to say 485 or so. Again, I'm going to left click bid. And now we want to go further away from this, and we're going to buy the 490. Left click ask price. Okay. Now you'll notice that it says iron condor on your end. The credit went up from 21 to 34. And the reason for that is we have two separate spreads going on at the same time for this position. It does make it a little bit riskier in a way because if SPY jumps up a lot, suddenly this call option could be much more expensive to buy out, or you might have to get stopped out of it. But you do receive more credit for the same amount of buying power. This still costs you $500, which is kind of a neat trick.
Really
Anyone
is.
know why it's still the same price and not $1,000?
No, I wouldn't know.
Can SPY be at 490 and at 400 at the exact same time?
I'd hope not.
I hope not, unless we're back to the future with our
Kinda rock,
time machine.
yeah.
It can't be at 400 and 490 at the exact same time. It's impossible. So what's good about most brokerages is they take that into account. You can't lose on both of these. One of these is guaranteed to work.
Oh, yeah.
And ideally, both of them work, obviously, because then we get the credit. So that's why it's a much more powerful tool to get more credit out of your positions. And then you could get really far out of the money to get a good return. 34 out of 5. We're looking at 6.8% in not even a month. Okay. So Jason, does that answer your question?
Yeah, so Lance, when you give the alert there, can you walk through what numbers we would place in first, like on your on whatever trading platform? I have a few different ones I'm using. I see you're on Thinkorswim, but like on the Discord, when you say do an iron condor, you have your numbers out there. Which one do we sell or buy? Is it?
Okay. So let me look at the trade for tomorrow. It says IWM Iron Condor for January, I think. So if you want to look at your Discord option trade tab, yeah, it says green IC 121.22, right? So let's open up IWM. And this is how I would go about putting in the trade, just like I'm showing from the alert. We're going to go to the 121.22. You see, I already have a position in it because I already made this one. Click that tab. Now the first number says 165 and the second number says 160. The first number is whatever you sell, and then the second number is what you're buying, okay? Another way to think about it is the number closer to the current price, we always sell because that gives us more premium. The second number we're gonna buy because it's less premium. If you're
Right.
selling something for quite a bit of money, you buy something for less, you're at a net credit in the end, right?
Yeah, so we're selling the first number on both
Yes.
sides.
Exactly. You sell the
Okay.
165, left click, bid. And then
Mhm.
we're gonna go to the 160, the second number, and it says P next to it. That's why I'm on the put side right now. Go to 160 at the ask, left control click. And then the call side, I did 248, 253. So at the 248, the bid price, we're gonna sell it.
Mhm.
Just press control click and see how it says sell.
Yes. Okay.
At 253 at the ask price, control click. And then your iron condor is set up. If you do it on the bid, click on the bid, it's gonna automatically say sell. And then if you click on the ask, it'll automatically do buy. So any questions on how I set that up?
I have a question in general. So for this to work, we ideally want the price to stay in between the call and the puts
Yes.
numbers, correct?
Between the sold call and sold put. So we
So-
want IWM to be higher than 165 and lower than 248.
But I guess my question that I don't understand is typically when you buy a put, say in this example, you buy a 160 put, you would normally profit if that stock goes well below that put price. And here, for example, like if you buy a call, if the stock goes higher than 253, you would profit. So I guess I don't understand why in general for an iron condor, you want the price to be still kind of flatlined, but of my reasoning of, you want calls to be higher if you're buying them at least at the strike price,
Right.
and strikes to be lower if you're buying puts. So
Good.
I don't understand how this actually profits.
That's a good question. Let's look at the put side. So 165 we're selling and 160 we're buying. Let's say at expiration on January 21st, IWM is below 160. Let's say it really tanks. We're at 150, right? Let's look at what happens to both of these options. The 165 that you sold, it says I'm running out of time in 10 minutes. I'm gonna have to refresh this, by the way. So
Yeah.
just an FYI. All right, so 165, I sold it. And then it's gonna go down to 158. Would that put option be worth anything if I sold it?
No,
No, it wouldn't, right? Because we're much lower and we're selling the put. We don't want to be selling that, we want to be buying it. The 160 put would be worth, let's say it ended at 155, it'll be worth $5, right? Because it's 5 less than the 160. In that case, we would essentially be profitable by $5, but then the 160, you're gonna be gaining as well. I'm trying to think of the easiest way to say it. Essentially, one of them is worthless, but the other one is gonna be essentially worth the difference of the strike prices. So if you're lower than 160, you're actually gonna lose the max loss, which is the difference of those strikes, which is $5. I'll come up with a better way to explain that later.
Yeah, I kind of understand a little bit more now, mentioning that, well, if you would sell that put, it's basically worthless, but then the buying of the put is a little bit, still has some money or premium to it. so,
Exactly, yeah.
Yeah, okay.
And that's why we buy the put a little bit lower because it makes it less buying power instead of using the whole 165 sell. The max loss in the situation is if it goes lower than the bought put. So if it goes lower than 160 and higher than the bought call, so higher than 253. In that case, you would lose the $500, which is the difference of your widths, but you also received your credit. So it's essentially 500 minus the 0.47. You lose $453. So we don't want to get to that situation at all. We want to do stop losses on it. And I can
So,
do that later if you want. Go ahead, Jason.
so Lance, on the Iron Condor you did yesterday on QQQ,
Yeah,
you sold the 340 and bought the 335 put, sold the 440 and bought the 445 call. Is
exactly.
that okay?
Exactly. That's what I have up here. Yep.
Great.
And then again, if you highlight it, it's currently at $61. You could still get in that tomorrow if you'd like, because QQQ didn't change dramatically from the prices from a day ago, and you still get a good premium off it. So that's again what I like about doing these long iron condors far out. You could even miss a day and possibly still be okay, but you want to DM me if it happens, like if you're a day or two late, just so we can double check to make sure it's still a good position or not. Because sometimes the premium might be a lot higher, and that means that the stock probably moved a lot. So you got to be careful on this. But if you get it in within the next day, it's usually good.
Cool.
Any other general questions? Would you like me to go over how to do the stop loss?
Greg sent out a message there.
Okay, let me see. Advise the stops. Okay. Yeah, I didn't even notice you said that until I read it. Okay. For stops, let's say for this particular position of QQQ, I don't want to lose a ton of money on this. So I'm going to do create closing order, buy it, but I'm not going to do a limit order. I want to do a stop order. Okay. And now with the stop order, it's going to actually fill if it hits a certain price or higher. Okay. So if QQQ starts to really, really tank and go near 445, or that would be going up, or if it tanks down to 340, this option will be worth a lot more than what it currently is, because it's more likely it's going to hit one of those strike prices. So you're going to do a stop order. I like stop, just market order. You could get more into the stop limit at another time, but it's really not needed. You want to do a good till canceled, not for the day. And then make your stop. I do 3 times whatever you receive in your premium. So if you receive 0.6 for this, do 60 times 3, you're gonna get 180. We would do a stop at 1.8. Okay? So the reason why we're doing this is I don't want to lose the full $500 because that's a pretty big loss just to gain $60, right? So what we want to do here is we're placing the stop at 3 times the premium. You end up losing twice the premium because of this, because we already collected that 61 in the beginning. If you go 61 minus 1.8, you'd be about negative 1.2. So I think that's a reasonable way to go from 61 to 1.8. The stock will have to drop or go up a pretty dramatic amount anyway in order to do that. I actually did do that with MasterCard today. I don't know if you noticed on the chat, I actually got stopped out of it. So it does occasionally happen, but if you just look at the numbers, if you're right 70% of the time or more, then you're going to be profitable in this position because every 1 out of 3 gets stopped out. Every 2 out of 3 you gain. If you're at 66%, you broke even. You got to factor in commissions a little bit. So if you're close to around 70%, you're already at a positive expectancy. And trades that I want to do are at least 85, 90% successful. Okay. Does that answer your question, Greg? I'm sorry, was it Greg? I think it was.
It was, yeah. You're gonna be running out of time pretty soon as well on the
We
free.
could do another, I could just open up a new one, right? And just post it on Discord.
Yeah,
I
yeah.
don't
we
think there's
could-
anything stopping us from doing that, right?
No, I just yeah, we should probably splash out on a Zoom membership or something. Instead
Yeah,
of
maybe.
me all the time as well.
I don't know how much it is. I have to look at it. All right. Any other general questions from the group?
Seems like we're good.
I could ask a question, but I know you only have 3 minutes left. Like for some of the cash secured puts, for example, Sophie, the SOFI, that took a dive the past week. Like for the cash secured puts, there's buy to close suggestions, but there aren't stop loss suggestions. So for example, right now I think I got that at like 0.41 or so for a premium, but now
Yeah.
it's at like $2.
Yeah.
So do I just let it expire and then do
Yes.
covered calls then later for that? Okay.
Exactly. That's how I'm gonna play it. I did that SoFi position as well. It has dropped quite a bit more than I expected to. But whenever we let it go to December 17th, I'm gonna let it get assigned because I'm pretty bullish on this long term anyway. And then I'm gonna sell a covered call at the same strike price that I sold it at. I did this in my other account. I forgot what the strike was. Is it like 20 and a half, 21 around here? I think.
Yeah.
Yeah, so let's
Yeah.
assume we sold it at the 20. If we then get assigned the shares, we're gonna be selling covered calls at the 20 also. And then you could receive right now for 17 days at the current price, you could still receive about $35 in that option, which is 1.5% about for 3 weeks. And that's still a good return, I think.
Yeah, because I was questioning, okay, the win rate is high supposedly for all these trades. But like, for example, this one, well, okay, I got the premium, but you know, it's negative still as far as like, because the cash secured put was
Right.
at 20. But I guess that does make sense that you could do the covered call, and then if it gets back to 20, well then, you know, it's I guess it would still be an overall a working trade. Is
Yes,
that kind of how
exactly.
you determine that win rate, I guess?
Yeah, I do the win rate based on the closed positions as a percent of what I get. So the SoFi, if it goes to the December 17th and it doesn't come back up to the 20, I wouldn't consider that a win, obviously. And then I'm just gonna wait it out until I eventually sell a covered call. If it bounced back up to that same strike price, I'll count it as a win at that point. Because
Okay.
sometimes it could be a few months before you have to wait. I'm gonna reset up a new Zoom, okay? If you guys want to check on the Discord, I'll set up a new link, okay?
All right, cool. See you in a second.
Okay, thanks.
See.